seeing across the markets and give you my opinion and view on it. So we've got this headline: more than 720 billion of stock buybacks will help the S&P surge to 4,700, says Goldman's. It's not just the share buybacks that make a lot of sense. And the reason companies do share buybacks is they can borrow the money relatively cheaply as things stand, and it enhances their earnings per share because there's fewer shares out there. So that enhances their share price, let alone the demand in the market that buying your shares in big chunks creates. Okay, but yeah, I agree that the markets should on balance go higher, but that's not the only reason why. By the way, we're doing this little competition for my students on my Great Investments program. They get a little medal for every 100% stock they pick based on our databases and so on. Anyway, that's an aside. Up again, major US stock markets are continuing to rise, and they're very much to the upside than the down. I tell you what, any hedge fund would love to have that performance as well. It's upside bias. What's going to happen going forward? Well, I suspect we're going to get more volatility, the types of which we saw around September, October time of last year. That's a guess. It doesn't matter whether or not that happens to me, because the kinds of stocks I'm going to be buying are the type which will be resilient should the markets fall and outperform should the markets rise. Okay, but if you put a gun to my head and said which direction is all this going in, I would say, you can see it there, I would say it's going to go in the direction or upward, 60-70% chances of that over the next 12 months, probably even more. But like I said, the markets are a fickle thing, and I don't gamble on whether or not it's actually going to go up. I'm going to take my view based on I want the kind of equities which will be resilient either way. Interesting statistics here regarding some of the companies which have gone public in 2021. Now, my normal strategy is to look for companies which are relatively undervalued, high growth, good dividend yields, good cash flow, consistent outperformers in the market. That pretty much assures me outperformance of the market. The problem with doing that with IPOs is there isn't much data because they've only just floated. So I tend not to do IPOs on the whole. The only time I'll do them is if it's experimenting outside of my normal strategy. So it's a higher risk, not the normal strategy kind of thing. It's put in a separate compartment. And I did that with both Roblox and Coinbase. And I'm right, don't bother. I'd rather wait for longer periods. When I wrote a column in the Financial Times many years ago on IPOs, I said the best thing to do usually is to wait for it to go above the first day's closing price. If you're desperate to get in any event, it's probably worth waiting longer than that. There is no clear IPO strategy based purely on the fact that either they're IPOing or the sector they're in, or the month in which they did it, or how much capital they raised, or even if they go above the first day's high. There isn't some consistent pattern with these, so we don't have to look at more data. Well, you don't have much data when it's an IPO. It's why Warren Buffett stays away from them. And as I say, it's not part of my core strategy either. Okay, this I'll come back to a little bit later. So where are we in terms of interest rates and valuations and those kinds of things? This is the S&P 500 real value relative to interest rates. Okay, so yeah, on many basis, it's overvalued. Well, we know that. We've known that for a long time. That's the reality, and it could go further up. So what does this tell us? Well, it tells us what a lot of journalists are saying and analysts. Oh, it's overvalued, but there's room to go up on balance. Will there be a crash at some point? There may be, but the kinds of companies that I have they won't defy gravity, they won't not fall, but at least I should be protected from some of the worst excesses of any market falls. I'm not trying to time any crashes anyway. Goldman Sachs is now the biggest stock bull on the wall market after adjusting S&P 500 target to forecast a 7% gain by year end. Yeah, welcome to the party, guys. You're a bit late, but never mind. You still get paid the big bucks. Wall Street stocks near record high ahead of crucial jobs reports. Will it continue? Well, like I said, if you put a gun to my head and ask me to choose what's likely to happen, I would most probably say, yeah, it'll continue, most likely, given the flood of money going in. Having said that, it still makes me think, well, I still need to have the kind of resilient companies which kind of stuff that I look at and read and the stuff that's on my desk, which, should we be wrong, at least we're not seen as gambling on the markets. What we're doing instead is protecting ourselves should those fall in any event. Internet sector revenue CAGRs and earnings valuations, not much you can do with that information there. We were looking to see if we could look at the performance returns versus the earnings and revenue multiples. So the enterprise value and the over the revenue. So enterprise value versus the revenue and what the multiple is. In other words, in one sense, price to sales, you could almost say. But enterprise value is just a different measure in one sense of the share price or the value of the company and revenues. And it appears that the ones which are some of the most expensive are the ones which are doing the most. Now you could argue, well, does that mean some of the laggards are going to catch up? I'm not going to read too much into this either way. Sometimes it's very easy in lots and lots of data to see more information than you genuinely should. Amazon was never cheap. This was an interesting article that came. Again, it was looking at enterprise value versus sales, and it's always been rather expensive most of the time. Apparently, they said during the sort of dot-com boom era, even back then, it was expensive, and yet it's gone on since 2000 to, I don't know, go up 100-fold or whatever, 1,000-fold, a gazillion-fold. S&P 500 forward P, another measure of how expensive is the market, going back to 2007. Yeah, okay, if you want, I can give you a ton of data which says it's expensive. Doesn't stop it continuing to go up. But like I said, given when it's at these levels, we should brace ourselves for any sharp retractions, which let's assume we're not going to call the market tops and bottoms exactly right. We better be in the kind of resilient stocks which continue to go up when the market rises, and will protect us from market falls. This is another way of looking at this. This was forecast from Yardeni, the banker and analyst and big brain in these things, and that's how they've gradually raised their forecast, and they've raised their forecast as well for the S&P 500. That doesn't matter. Goldman Sachs names 26 stocks with solid balance sheets to continue beating the market as the Fed's tapering plans to trigger chaos elsewhere. Put another way, what they're actually saying is, if there is to be chaos, if there is to be all these problems, then the kind of companies that they are going to look for are the ones with solid balance sheets. Well, accounts comprise of three things: balance sheet, profit and loss, and cash flow. Okay, so we don't just want solid balance sheets ourselves. We want strong profit and loss account, strong cash flow. How do we measure cash flow? Well, cash return on capital employed is a good measure. It's actually the same measure Goldman Sachs happen to use. The P&L account, we're going to look there at the profitability and the profit growth of the company and the sales growth of the company as well. So actually, we're going to look at the balance sheet to some extent, just to make sure that, yes, they've got lots of cash in the bank, but actually it's the other two factors which we think are even more important. And why would you ignore them? Why on earth would you ignore in your accounting, when your accountant fills there and sends them to a taxman, does the taxman say, oh, just send me in your balance sheet? You don't have to sell me your P&L and cash flows. Actually, you don't have to sell your cash flows or your balance sheet. But why would you ignore it? My accountant certainly wants to see all three. Legendary tech venture capitalist Mark Andreessen says Warren Buffett's philosophy, putting all your eggs in one basket, is the best investment advice. The reason I want to showcase this is because, in actual fact, some of the wealthiest people have got wealthy not through taking great risk, but actually because the average person assumes that they're taking less risk by being diversified. So they'll buy, as I saw with a client recently, 10 funds, and each one of those funds will have 40, 50 stocks. So that's 500 stocks they own. 500 stocks. Just do the maths. That means they've got less than 1% of their capital, most probably in every single one of those stocks, if they were to distribute it equally. Okay, which roughly will be what will have happened. So they've got less than 1% of their capital. Should that amazing fund manager pick a good company, then it'll barely make a blip of a difference to the stock portfolio of the investor. Investors tend to be over-diversified. They tend to rely less on picking good companies which are going to get a return. Investors flocking to quality in the stock market as the economic cycle nears peak growth. BlackRock says BlackRock manages trillions. Yes, they're flocking to quality. They should have been flocking quality for a flocking long time, I can tell you. The reason is, and what's the definition of quality? Valuation based on profitability and profit growth, growth of a company, sales growth, cash flow, capital, cash return on capital employed, for instance, consistency of outperformance. These are all factors which suggest quality in a company, not great marketing and PR and all of those other things. By the way, going back to Warren Buffett, when he talked about, oh, you're on a company with a moat and a brand and all of these things, what he was essentially getting to is all of those peripheral things should show up in their balance sheet, their cash flow, and their P&L in terms of the characteristics that I mentioned. He was just putting more flavor to it at a time when getting that data wasn't very easy. Okay, super investor portfolio stats, top 10 most owned stocks. This was data from, I forgot which brokerage actually, just out of interest. These happen to be 10 most owned stocks. And by percentage, doesn't mean I'm going to buy them as a result of that, but it's just interesting to sort of tie it in with some of the other things we already just mentioned. What's that? Oh, I better turn myself off again. Wall Street analysts are bullish as they are as bullish as they have been in nearly 2 decades. Yeah, they're still bullish, but analysts have always been rather bullish, and they're not necessarily the best predictors of which way the market's going in any event. They tend to be quite lagging. But that suggests there's even more room for them to be even more bullish. Wow, if they could do it. Those bonuses they're getting certainly get them excited. Wall Street's 10 most accurate analysts say you should buy these 10 stocks right now for immense upside over the next 12 months. Do you see what's happening with headlines? You're getting a lot of clickbait. And most accurate analyst, you should buy the... Wow. Keep calm. Just because an analyst says it. I mean, think about it. He's an analyst. Not a fund manager, not managing his own capital. He's an analyst. Okay? You still want to be, I think, finding out so you can get better sleep at night. Valuation, growth, income, cash flow, momentum. Which direction has it been going in the recent past? Has it survived very well the recent turmoils, whatever there might be in the market? At any given time, is it consistent outperformer? In other words, alpha and Sortino are 2 very important things. US stocks climb towards record on GDP, jobs data market. That's right. Well, GDP and jobs data, that's right. There is what Keynes called animal spirits, which is the X factor in the markets, which allows for some level of unpredictability. And that blasted X factor is, I think, pretty good at the moment. There's animal spirits, there's excitement, there's business people I speak to. I must speak to hundreds in a month from around the world, and they're optimistic. It gives me a pretty good idea how they are feeling as well. Okay, company, Amazon, Samsung. Oh, these are just the earnings that I just put on my Telegram. Alphabet, YouTube ad revenues. Can you believe it? Ad revenues are holding up pretty well. I suspect they're going to continue holding up. Actually, no, let's have a look at that. Yes, these big 5 tech companies, there we go, do account for a large chunk of the S&P. The top 5 contributors to the S&P market cap percentage. So the market cap of the S&P 500 is almost 20% composed by 5 companies. That hasn't ever been the case. You know, in the past, the top 5 have been maybe contributing 5%, 10%. In other words, you're getting a large chunk of the S&P's 500's performance by just owning these 5 companies. And I suspect these 5 companies will continue being dominant. I don't see anything they're doing as being something which is about to turn the tide. I'll remove my, I want to see me, dear. Yeah, there you go, remove my picture again. China doesn't really matter. This was earnings from a few weeks ago. That doesn't matter. Earnings optimism, stocks extend weekly advance. Let me tell you something. Any economist worth his salt will tell you that economics has moved on and appreciates that a lot of economics is about behavior and expectations within that. As long as earnings exceed expectations, so our expectations are muted compared to what profits actually happen and we get upside surprises, share prices continue rising. That could be irrational, but they'll continue rising. So what is going on? What is going on? Well, what's going on is we look around the world and we think about Afghanistan or COVID or whatever else, China, and we think to ourselves, we better mute our expectations. Yet the companies are delivering good earnings. So stock prices keep rising. That's another explanation of it. Retail investors, this is data from Vander Research, retail investors' daily net purchase of US equities since 2016. There's a new normal. The private investor is buying into the stock market. They're getting the bug again, like they did 20 odd years ago when I wrote some of the books you can see over my shoulder. Whoops, over that shoulder. Okay, over that shoulder. And they're buying dips, and that's helping the market continue to rise. Okay, and there you go. Retail traders pile in amid the sell-off. So this is what we saw in July. There's a sell-off. Retail wants to get back into that sell-off. And again, put another way from Bloomberg, day traders take Wall Street by storm again, record dip buying. So it's not just me. This is independently verified by respected journalists like those at Bloomberg. Dow futures rise more than that doesn't really matter so much. This is another measure of the S&P and valuation. Recent risk-adjusted return ranks in the top 5% of all days since 1960. Risk-adjusted return. It's a measure of you are making easy money. What it's saying is that the return you're getting for the volatility in the market, it's almost unknown. Doesn't necessarily mean it's going to fall back. It probably will revert to mean because it can't continue going like this. What it's saying is it's almost a one-way bet. Every day the market keeps going up. That's another way of saying that. It's a cleverer way of saying that. Will that continue? I hope so, but it never has in the past. S&P 500 drawdowns over the past decade. You can see by how much you can get those drawdowns in the interim. Look at that. Some of those are quite significant. Falls, this doesn't matter so much. Present inflection point, that doesn't matter. I don't want to go into that. Bitcoin. Board Lehman trader builds a $6.7 billion fortune with a hot app. Can you believe it? More people are going into entrepreneurship. Things are fantastic for entrepreneurship and people going into different sectors. Recent rise in the S&P 500. Well, which sectors are doing well, which aren't? I don't sector pick. I'm bottom up. Okay, I'm bottom up. So what I tend to do is look at the stocks and see how they're doing. I don't try and gamble on a sector. But it just so happens tactically, a lot of those sectors which are doing well, or companies doing well, happen to be in the sectors which are doing well. Of course they would, because one of the criteria we look at is most recent momentum. And so that would, in any event, remove some of the worst performers for us. It's a very simple way of removing bad performance for us anyway. So that's just a different way of putting in what we do. The Dow, when I put this up, and it was last month, and I said it could drop down to there and will continue up, that happened in a day. I thought it would take a few days to happen. It happened in one single day, did that, okay? Worst week in a month for Wall Street, blue chip, yeah, worst day in a month, and it recovered almost immediately. I want you to bear that in mind. Don't need to look at those. I'm going to leave it at that. Oh, this has been one of my best picks. That's something I want to let you know. Look at Finnish and Swedish companies. As long as they've got good value, growth, income, and so on, they're going through the roof. Technotree is another. Harvia is another. I mean, look at that. I mean, you want a hedge fund with that performance. You want any fund with that performance. So anyway, hope you've enjoyed this. Follow me on LinkedIn, on Telegram, where I put some of these images up as well. If you're not sure where to look, there'll be some links around this, but look at alpishpatel.com and there'll be a load there. Have a look at my campaignforamillion.com, actually. Look at that instead, a campaignforamillion.com. It's to teach 1 million people how to be better investors. Okay, and there's a whole load of free books and lectures and talks by me, which are sort of bite-sized, 3 minutes long, to help people understand the markets better so that they can have the confidence to open a SIP or an ISA and have the confidence to maybe, I don't know, buy Microsoft or whatever is suitable for their particular circumstances, but at least have the confidence to get on with it and not have their money sitting in a bank account earning nothing, and hopefully get some returns for their old age, but at least get into that saving and investing habit. So have a look at campaignforamillion.com, and that's over there. Thank you very much.